wanted to say for all of those that serve, like Henry and the others that are on the call, welcome home. So it's hard to believe it was 50 years ago, the last combat troops were pulled out of Vietnam. And then about 3 days later, I believe it was 3 or 4 days later, those POWs that were there up in Hanoi and so forth were all released and came home. And as of today, we still have over 1,900 MIAs. And there's still one from Washington High School who's an MIA. So with that said, welcome to the Kushner Report for March 20th of 2023. And at the conclusion of the discussion this morning, we're going to have a Q&A time frame for us. Everybody will be able to participate in that as we get started. So one of the things I want to talk about here's our agenda for today. We're going to look at the key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news, and what's ahead in 2023. And today, we're going to talk a little bit about the recession update, and then we'll focus a little bit on oil and gas for 2023. So the first thing I want to talk about, I was on 2 calls within the last week with economists that are out of Wall Street. It was very interesting. And let me just kind of give you a synopsis of what transpired. So, you know that a recession is looming. It's just a question of when it's going to take place and how deep it's going to be and how long it's going to last. So here's a couple of the positive, or what I would call optimistic comments that were made. First of all, we still have a strong consumer spending taking place throughout the country. The labor market and job creation continues to be strong, as I'll show you later in the presentation, and significant credit card spending continues. We also see expansion in the airline industry, which is continuing to gain momentum. And we have increased dining is taking place since the pandemic has subsided. And then hotel occupancy is starting to come back slowly, but it's coming back. From a pessimistic or negative perspective, inflation continues to flourish with slow improvement. And core inflation removes the impact, if you will, of fluctuations in food and oil prices, which are there. And it tends to be a real problem for us throughout the country. The housing market continues to decline, and it's taking major hits throughout the United States. Manufacturing sector is below 50 basis points and is contracting. And there are signs of a weakening labor market as layoffs begin to mount. And consumer confidence continues to decline, indicating that a recession is imminent. And the labor market, as I said, is dropping, and we're seeing unemployment rates going up. And again, the status and concerns of the banking industry and the turmoil that lies ahead, there's still a lot of unknowns yet. Hopefully the worst is behind us in that area. So in summation, what I'd like to say is the following. We have a strong economy persisting at this time, but there are concerns in the near term. And inflation, again, continues to impact purchasing power, and that's a real concern for both the middle class and the lower classes. And then, of course, you have a current collapse in the housing market, depending where you are, and I'll mention that about the Bay Area later in the presentation. And again, the Federal Reserve, as far as I'm concerned, a lot of economists believe they waited too long to take steps to curtail inflation with interest rates. And we'll have to see what they're going, and many feel that we're going in the wrong direction. We're just going to have to wait and see over the next few months what takes place. And then many signs and indicators that a recession will begin in the second half of 2023. However, most believe it'll be short and with a soft landing. The key economists from Allianz last week indicated that they're betting on it's going to be probably an 8-month period of time where we'll see being in a recession, then we'll start coming back out of it. Now I'd like to take a look at the oil outlook. So oil industry is still very important to the United States as well as the rest of the world. So, oil and the natural gas systems really encompass the wells, gas gathering and processing facilities, storage and transmission, if you will, and the distribution of pipelines. The key ingredients here are the production area, which is taking the raw materials, if you will, natural gas and underground formations, and then gathering and processing this, stripping out the impurities, coming up with natural gas, etc. And then we have the transmission, which is the delivery of oil and gas naturally across the country to its end users, to basically city, state gates, or in many cases to the industrial end users. And then finally, you have distribution, which is really the delivery of all of these through the pipelines. And so far, the pipelines seem to be pretty strong. We haven't heard of anything happening. Typically, where WIP is down there in the Houston area, you usually have problems with pipelines during the summertime because of tornadoes and hurricanes and everything else. And hopefully we had that last year. We had some impacts in the Dallas area as well. So let's hope that doesn't happen this year. When you look at crude oil production, basically, we expect to see crude oil increase in terms of output in 2023 and 2024. So this year, expectations are we see production around 12.4 million barrels a day. And then in 2024, we're talking about 12.8. And both of these exceed the record that was set of 12.3 million barrels a day back in 2019. Output is expected to average about 840,000 barrels a day, and it increases across the board, which hopefully that'll be sustainable. And of course, experts are looking, natural gas production. In general, we're seeing an increase of about 2% this year, and hopefully that'll carry over to next year. In terms of capital spending, the oil and gas industry earned record profits last year. I'm sure most of you know that from going to the gas pumps, and provided ample cash flow to fund strategies going forward to 2023 and 2024. And recognizing that we have trade restrictions and macroeconomic uncertainty in the year ahead, a lot of this is going to play into what transpires. But they've also been clear that there's a mandate to secure supply in the short term while transitioning to clear energy in the long term. So again, you can call it an oil company, but they really are looking at transitioning away from oil products into other areas of fuel efficiencies. Now, if we look at the industry directions here, in the direction here in 2023, it's more likely to be turned. There's a lot of actions and a lot of moving parts that will take place at this time. For example, the balance sheets of oil and gas companies is very solid based upon what's transpired over the last couple of years with the price of oil and the cost of developing products. And the role of the oil companies is accelerating in securing the energy transition. We also see that the dynamics of natural gas demand and the resultant policy environmental changes have had a major impact. As you know, the real concerns were the East Coast and what the implications would be if there was a lack of fuel, especially with a cold winter. And the direction of deal making and the interplay of energy security transition is stepping up all across the board. The real key is this: entering 2023, the oil and gas industry has the healthiest balance sheet it's had in decades. So this is very good news in terms of refining and looking for new areas of emphasis. Now, when we look at what factors could impede 2023, well, first of all, you have competitive pricing of fuels. And that is, you have sustained high natural gas prices, which could make green hydrogen and biomethane more attractive for future investments in the technology space. There's also concerns across the board about biofuels. In other words, often relying on the production of grains and vegetable oils, et cetera, to be used in the area of fuels and so forth. And the public, if you will, there's complete opposition against that. So we'll have to see where that goes later in the year. And of course, you have new infrastructure challenges, which in terms of liquefied natural gas projects, such as carbon capture, utilization, and storage, is on the horizon as well. So there's a lot of money that needs to be spent in that area. And again, the industry is resilient. And of course, there's a lot of uncertainty lying ahead. There's significant federal funding has earmarked a lot of programs for hydrogen. And the government has really allocated over almost $2 billion in loans to two major hydrogen projects. So we'll see where that goes. Who knows? One day, Sid may be driving a car that's using hydrogen as opposed to electric. You never know. And of course, you've got the regulatory issues right now. There's a timeliness about the content of new regulations that continue to be generated on a daily basis that has an effect on oil and gas. For those of you who live in California, the governor signed a bill into effect to do something along the lines of holding the oil companies accountable for the pricing, if you will, of oil products, gasoline specifically. Comment was made that we're $2.61 higher than any other place in the United States, and they're trying to get to the bottom of that. And again, we have a lot of money that's wrapped up in taxes per gallon. And then, of course, you look at the supply chain constraints. Clear energy transition will require significant investments in infrastructure. We're talking about pipelines, storage, and biofuel refineries, and of course, technology. And of course, the grid and expansion modernization is taking place as we speak. There's going to be a massive investment in that particular area. So again, continued projects and projects, if you will, in progress is really taking place as we see growth continuing. But the challenges are going ahead in terms of what's taking place around other parts of the world. Now we can take a look at our friends in OPEC and Russia. And of course, as you know, they agreed to reduce the production of oil by 2 million barrels a day. And that's the largest cut in production we've seen in many, many years. The intent here is that OPEC and Russia would like to see the price of fuel between $90 and $100 a barrel. And I'll take a look at where we are later. So that has a major effect on our economy going forward. If you look at the global situation, the possibility of petroleum supply disruptions and slower than expected crude oil production growth continues to create the potential really for higher oil prices. And while the possibility of slower than forecast economic growth creates the potential for lower prices. So it's hard to tell what would happen if we go into a recession. What will that do to the price of oil in the second half of the year? That's to be a topic of another discussion later in the year. So now I'd like to take a look at the key economic indicators. I'd like to look at inflation, unemployment at both the federal and the California level, and of course, the price per barrel of oil. If you notice the asterisks, all of these elements have changed since we last had our last discussion a month ago. So first of all, global GDP is now targeted at about 2.2% and going out next year around 2.2%. The United States is down to 1% right now, and then we'll think it could go back up to about 1.5 next year. Inflation, if you can look at this by the end of the year, it went out last month around 6. It's pegged right now to go out about 4.6%. And again, we're still early in the year. And then next year dropping down to 4.3. Now, if the targeted amount, which is 2%, which may not be realistic anymore, that won't happen if we get near that. It'll be sometime in 2025, unless something dramatically occurs. The unemployment rate for this year on a national basis is looking around 3.7% and going up to 5% next year based upon the lag time if we go into recession and we continue to see the layoffs that we've been seeing over the last couple of months. And if you look at California, the unemployment rate is anticipated to go out this year about 4.5% and up to 5.1% next year. Again, the impact of the recession and the lag time. The price per barrel of oil, we're still looking at a target range now, a little bit lower, somewhere between $80 and $100 a barrel by the end of the year. Now, taking a look at the global economy, a lot of activity in the last month. So first of all, although there has been some mild encouraging developments in the UK, the outlook for the British economy remains distinctly subpar at this point. The UK has narrowly avoided a recession. And we're seeing now that in other areas, for example, economists have upgraded the Chinese forecast, which is important. The sentiment here is now it's looking more like their GDP could go out the end of the year at 5.5%, which is significant compared to what happened last year. And major other economies, such as looking at the fourth quarter, Australia grew less than expected. Their GDP is down. And you look at both Canada and Switzerland and Sweden economies in the final quarters were somewhat flat. And Swiss inflation continues to rise. And the Swiss government, along with other companies in the Eurozone, have all raised basis points last month by 50 points, not 25, but 50. And in the Eurozone, basically, there's the loan to ratio deposits is evidence in recent years. It's the highest it's been in a long time. Now, taking a look at domestically, what's happening, a lot of activity. So first of all, as you know, the U.S. regulators seized the bank, Silicon Valley Bank's asset about a couple of weeks ago, making it the largest bank failure we've seen in decades. And this is going back to the 2008-9 timeframe when I was with Deloitte and we saw Washington Mutual Bank fail. And as Sid indicated this morning, the failure was predicated on run on the bank, they ran out of cash. And so there's a lot of activities taking place in the last 2 weeks. As you know, those folks that had below $250,000 are safe and secured. And we have a couple of folks on the call today that have moved funds out of Silicon Valley Bank, other banks. The one thing I wanted to say is this. Thanks for Bill Holtzman. Both Silicon Valley Bank and Signature Banks had strikingly high share deposits above the $250,000 limit. Now, 94% of Silicon Valley Bank's deposits were uninsured, and 90% of Signature Bank deposits were uninsured. And that's pretty scary. And the other banks are somewhere about half that or lower than that. So that's something of note to take a note of. And right now, there's a lot of moving parts. We're not going to know what takes place for probably a year of all the analyses being done with the Justice Department and everybody else as to what the causes were directly and what implications that'll have going forward. But you can bet that over the next several months, the banks will tighten down credit in the banking area for loans, et cetera, and they'll probably tighten down the loan requirements as far as credit cards go as well. As I mentioned earlier, the regulators, a crypto bank basically, when the bank Signature Bank failed, the bid there was, again, running out of cash. Signature Bank is one of the main banks of cryptocurrency industry. It was the biggest one next to what we call Silvergate. And so from that perspective, that had a major impact in that currency type of activity. Now, banks borrowed about $165 billion to push back and solidify liquidity in the marketplace, which is a good sign. And again, Wall Street mentioned that there were possibly 11 other banks that they were very concerned about. And again, we haven't heard anything, but the good news is for First Republic Bank, which is a Bay Area bank primarily, banks such as Bank of America, Wells Fargo, Citigroup, and JP Morgan all basically contributed $5 billion to raise the $30 billion to keep the bank afloat. So that's good news. And there were other people as well, different trusts, Bank Court, et cetera, all donating money for the cause to keep the bank afloat. The real concern we had, and I've talked about this in the past, is the growing interest in credit card debt. And the credit card debt now to the level is back to the mid-90s. And what we're seeing now is the fourth quarter of last year, the debt was $931 billion. And there was an increase of $85 billion. That's the highest on record. And the concerns are that those debts are going to have to be paid down. Keep in mind, a lot of people using credit cards for groceries, whatever they do, using that versus cash, because things are pretty tight for most people in the economy. And again, the shocking plunge in the construction job openings as the Fed raised interest rates. We saw, for example, that the industry reported just 248,000 job openings in January, and that's almost half of what it was over the last 3 or 4 months. So there's a real concern there in the construction industry. Now, I'd like to move on here. So when we look at inflation, as I mentioned earlier, inflation dropped down. It was up 0.4 points, but on a year-to-year basis, it's at 6% right now. And again, as you know, the goal is to drive that thing down as quickly as possible. And I believe that the banks will continue to raise interest rates by 25 basis points over the next few months. And hopefully later in the year, there's speculation that they may start reducing interest rates latter part of the year, maybe in the beginning of the fourth quarter. The good news here is wholesale price inflation dropped down about 0.1 point. It's the first time we've seen that in 6 months. And that's great because that's a key thing where those products go on to the retailers, to some Macy's, and then they pass that on to you and I. Trade exports increased by almost $9 billion. It's a 4-month high. We saw that go out at about $258 billion. So that's very strong. It's good news for our economy. The trade deficit widened again by 2%. It was at almost $92 billion. And if you think about that times 12, you're looking at almost $1 trillion in deficit. And again, that's not good for the economy. We've got to get that down substantially. Retail sales were modest last month. They rose about 0.4 point. Actually, they fell 0.4 point. Now we'll take a look at the job situation. So first of all, we had another strong month on a national basis. We saw the creation of 311,000 jobs. However, the unemployment rate increased to 3.6% from 3.4% in January. And the only thing to look at here is like the health and education sector and leisure and hospitality both had strong returns. Keep in mind, those are the two areas over the last 2 to 3 years that got wiped out with job losses. So they're coming back now, and that's good for the economy. Taking a look at the state of California, in January, in February, we saw jobs, about 32,000 jobs were created, and unemployment increased to 4.3%. That's up from the 4.2 we saw in February, actually back in January. The only thing of notoriety here, again, was leisure and hospitality of 11.2 thousand jobs. Everything else was relatively small. Now, taking a look at interest rates, you know that the Federal Reserve had the open market committee last month, and they raised it 25 basis points, and they'll meet again in April and May, and we'll see what happens. Speculations is we're going to see two more 25-point raises, okay? And if the inflation continues to get worse, we'll see it occur again in June and July. The good news is on the mortgage rate, it dropped down. It was over 7 a few weeks ago. Last Friday, it closed out at 6.72%, which is good. So we're seeing more activity. And I mentioned manufacturing, and my concern is I've always been a manufacturing person. I've loved manufacturing since I worked at Xerox out of college. It's in a contracting mode right now. It dropped down again to 47.7%. And again, when you're in that mode, you're either in a recession or entering a recession. So the objective is to get that up over 50 basis points. Factory orders fell last month, primarily because of civilian air traffic products were down quite a bit. And we saw the factories drop 1.6% from December. That's the first time we've seen a decline in factory orders in some time. Small business confidence level increased a little bit to 90.9, which is good. That's the highest we've seen in 3 months. Earlier last year, we saw well over 100. So the real target is to be well over 100 basis points. Crude oil prices, here's some good news. In January, it went out at $76 a barrel. Last week, it closed out at $69.20. So it's down about $7 a barrel. That's good news. And hopefully, we'll see that reflected in the pumps in the next month or two. And gasoline prices here, at least in San Diego, are starting to drop, 5 cents here, 10 cents there. So we're seeing it declining. In the housing market, we had an unexpected surge. We had a 5-month high last night. It was at 9.8% growth on a seasonal basis last month in February. That's good news. A lot of that has to do with some decline in the mortgage rates. In terms of new home sales, we saw a rise last month of 1.1% over January, but still 19% below where it was a year ago. Now, turning to Southern California, in Los Angeles, the median home price was at $723,000, and that was up by 6%, while sales increased by 2.7%. However, that's a drop of almost 34% from a year ago, the same time frame. In Orange County, which is the strongest in the counties in California, we saw the median price of $1,159,000 decreased by 3%, but sales were up by 8.9%. But they were down to about 26% from February of 2022. And in San Diego, the median price of $875 increased by about 1.5%, and sales were up by 11.5%, which is a drop of about 32% from the prior year. The real buyer's jump here is that the existing home mortgages sit in February were up by 14.5%. So that's good news. We're seeing more activity in that area. So hopefully, as we start moving to spring, housing market will start to come back a little bit better. I mentioned to you before about construction. Construction spending was down 0.1 of a point over in January, and then we're seeing a little bit more of a contraction. Now, the productivity report, it will not be available probably until May for the first quarter. As you know, now the government only reports on productivity once a quarter. Now, the area of company displacements last month was the worst I've seen since we've been doing the program. The good news is this month we had a lot of companies doing it, but probably less than half as many as last month. However, I just want to mention the companies that are over 1,000 of significance. So McKinsey Consulting, if any of you worked in an industry and used them, it's the largest layoff ever. They laid off 2,000 people. Citigroup had 2,000 layoffs. Facebook had cancellation of 5,000 open requisitions and a layoff of about 10,000. Amazon, 9,000. Credit Suisse went through the acquisition by the other bank in Switzerland. That's 9,000. Indeed, which is in the job search business, 2,200. And then finally, Accenture, which is a major, large consulting firm, worldwide basis. They used to be part of Arthur Andersen, 19,000. So that's where we are right now. And again, we're seeing a lot of triculation going on, especially like in San Diego, 50 here, 100 there. That'll continue until we see the change in the economy going forward. So as we get into mergers and acquisitions, the reason you're seeing a lot of activity right now is a couple of reasons. Number one, interest rates, even though they are where they are right now, they're still very low compared to where they were years ago when M&A deals were taking place. Number two, you're seeing a lot of consolidation taking place in different vertical markets. And that's going to continue because as you have slow organic growth, and if you're publicly traded, the pressure is on to grow business. And the way you grow it is by getting rid of lines of business that don't make any sense anymore, are unprofitable, and by going out and buying your competition or buying a company in a different vertical market where you'd like to expand your business. So starting with Dick's Sporting Goods is one of their last remaining ones, they and Big Five and maybe a couple of smaller players, they bought a company called Moose Jaw from Walmart. And what the acquisition is doing is it's allowing them to move into the outdoor marketplace to increase a new vertical market for them in terms of the sports business. UK-based Enos is buying US Eagle Ford Shell Company for $1.5 billion as they want to expand into the US gas and oil marketplace. And Amazon, again, is busy. They bought an acquisition, One Medical, for $3.9 billion. It's an acquisition. It's a primary care provider in the area of various places in the United States. Again, the acquisition basically lets everybody know they're continuing to move into the high technology in the healthcare industry and becoming an even bigger retail giant. So they're expanding into healthcare. Now you have Mercy is acquiring Genesis Health. Here again, it's another consolidation taking place. This is taking place mostly in Iowa, but the firm is really developing a new line of services to expand and generate more revenue. Coinbase is acquiring River Digital Asset Management. This is a crypto exchange, which is expanding its business, and they're moving into more core business lines, especially in the area of retail trading. You look at Blackstone is acquiring Ancestry.com for $4.7 billion. So Ancestry is giving the investment firm the total amount of all of their DNA from every person who's ever used the services. So they will become the world's largest provider of DNA services, which is amazing. And then we have Selena Specialty Chemical is acquiring Diversify, and basically there's another consolidation taking place in the industry. Pfizer is active again. They just acquired a company called Seagen for $43 billion. And this is to deal with the expansion in the area of cancer drugs. So again, they're expanding their foothold. You know about what took place during the pandemic, but they're continuing to grow their business and expansion. T-Mobile is buying Ryan Reynolds. It's a Mint Mobile company for $1.35 billion as they want to expand their marketplace in the mobile cell business. And UBS, as I mentioned earlier, buys Credit Suisse for $3.2 billion, and that's to shore up the global banking situation. And we'll see what takes place over the next several months about what they're going to do and which markets they're going to continue to participate in. Now, Knight Swift is in the transportation business. They're a large company involved in truck transportations. They're acquiring Chattanooga-based US Express for $808 million. And what they'll do is the Express will continue to operate as an independent organization, but this will give Knight Swift a larger piece of the puzzle for truck transportation. And again, as I mentioned earlier, now is when we want to take a look at other significant news. A lot of stuff occurred last month. So first of all, I mentioned earlier, banks borrowed $165 billion, and the idea is to get back to stop liquidity issues. So I think we're strong there. I think the worst is behind us. And what we're seeing now is that what's interesting, as I mentioned this last month, I have a colleague of mine that I worked with at Deloitte for years, lives in the city, has a condominium. You're seeing the prices getting crushed in the marketplace for townhouses and homes in the Bay Area. They plunged as much as 35%. And over the last year, if you can imagine, 56,000 people, residents alone, have moved out of San Francisco. And that's what's taking up in that particular area. Now, Microsoft has made another good strategic move. What they're doing is, we talked a little bit about this last month about OpenAI chatbot technology. What they're doing now is they are beta testing this technology, which they hired two folks away that used to work for Google. They're now working for Microsoft. Microsoft has invested $11 billion into this technology. The idea is that hopefully by the end of the year, they want to be able to have this technology in their office products, such as in PowerPoint, Excel, and Word. And I've used it. You can go online and use it. It's kind of fun to use. You can go online and ask something, and it starts generating, it can write a paper for you. But keep in mind, there's a lot of issues that have not been resolved yet. In other words, the quality of the data that it's presenting, where the data is coming from. But this is something that's really going to be interesting. There's good news here and bad news. So if Bill Holland and I were going to USC and we had to write a paper, I could go online and say, I need this particular thing, and I put in all the variables and would come up with a paper that I could use for helping me put my final paper together. We didn't have that in the old days, but that you get another advancement here. This is going to have a major impact, I believe, on Google going forward, if this thing really works well. Now, Target is investing $100 million in their sorting centers to make their delivery faster and cheaper. They've had a lot of problems with supply chain and moving products around. U.S. homes value, if you can believe this, they've lost $2.3 trillion in value since the June peak of last year. $2.3 trillion. That's pretty significant. And we looked, as I mentioned before, the Bay Area marketplace, housing up there, what's happening. Tesla is building a new plant in Mexico for $1 billion. And the intent there is to expand their manufacturing process and operations into Mexico. It's worth about, as I said earlier, about $1 billion. And the U.S. Post Office is buying another 9,250 electric vehicle Ford delivery vehicles. And they're also going to planning on having 14,000 more charging stations available to all their facilities throughout the United States. Tesla, again, is taking another step. Their Model S and X prices, again, for the second time this year, they've dropped as much as $29,000 a vehicle. And Amazon has made another strategic decision here. They're closing 8 Go convenience stores in their latest line of tightening up on physical retail. It's the latest move to pull back out of the brick and mortar business that they've delved into. And then we have Scout Motors has picked South Carolina for a new $2 billion electric vehicle plant. What this will do, they want to build and produce about 200,000 vehicles a year, and at the same time they'll create 4,000 new jobs, which is great news. Now, for those of you in the commercial real estate business, CRE has joined Amazon, Microsoft, and other Fortune 500 companies. And what they're doing is they're halting major office developments. So they're pulling back on expansions in different headquarters around the United States because of the change in the workforce. For those working more at home, et cetera, the question comes up, how much office space do you really need? And so you're seeing that pulling back right now. That's taking place. For those of you that have eaten Kellogg's Corn Flakes and other Kellogg's products, the decision has been made to break the company into 2 independent operating companies. One will be a snack company to be named Kellanova, and the other one will be the North American cereal business company called WK Kellogg Company. Now, the first time in many, many years, we see a new acquisition taking place that U.S. Railroad Company consolidation is taking place here. So Canadian Pacific is buying Kansas Southern, if you will, for $31 billion. The idea there is to see more roll-ups taking place in that industry. Now, for those of you that are involved in sports, such as Mr. Holland, there's a group called Diamond Sports Group, the largest owner of regional sports networks, filed Chapter 11 bankruptcy protection. The move came after it missed a $140 million interest payment. So Diamond owns basically 19 networks under the Valley Sports banner. These networks include such as 42 sports teams. We're looking at baseball teams, the NBA, and NHL. They'll continue to operate under the bankruptcy charter, but something will have to be done. If you can believe this, on their balance sheet, they have almost $9 billion in debt. So that's significant, and that you usually don't think about that in the sporting goods area or in professional sports. So with that in mind, I'd like to open up to question and answers. Okay. Oh, I forgot the last sheet there, huh? Okay, sorry about that. Anyway, I mentioned the layoffs. We've seen Wall Street, the most layoffs since we've seen in 2008. Again, Americans are falling further behind on car payments. And then Boeing is planning to hire 10,000 people. As you recall, one of their particular airline products has been grounded for a long period of time. That's up and running now, so that's good news. And then we're also seeing General Motors is going to invest $650 million in the U.S. Lithium mining, which is something critical to the battery industry. And Apple's first quarter declined for the first time in 4 years. And of course, Bed Bath & Beyond continues to struggle, and it looks like they're going to enter bankruptcy sometime in the next few months. And of course, BB&B is winding down Canadian operations in Canada. They will no longer see Bed Bath & Beyond in that area. let's see here. And other used cars prices, we saw inflation worries here where used car prices continue to jump. And then GM and Global Foundries has decided to put together a new chip manufacturing plant to be a sole producer for that particular industry. And then, of course, Ford and a Chinese partner are building a battery plant for $2.5 billion. And Walmart closed 3 of their hub tech centers. One was in San Diego, and they're consolidating in other cities. And then, of course, we're talking about the U.S. had drew 26 million barrels out of the reserve. And of course, KPMG, for the first time, cut staff. It eliminated about 800 or 900 jobs. And now they're at the forefront because KPMG were the auditors, I believe, for both Silicon Valley Bank and the bank, the crypto bank back on the East Coast. So now we'd like to turn to question and answers.